Yes, you are live.
Okay, very good. All right, let's call the April 26th, 2021 meeting of the Investment Advisory Committee to order. First up on the agenda is the roll call. Steve Knobloch.
Here.
Rick Carter. Rick Carter is not here. Al Sondag.
Here.
Bill Blackwell.
Here.
Okay, and also with us is Jason Schmidt from Chandler and Courtney as far as the staff. So,
And Sandy Chiswick.
okay, great. Hi, Sandy. Let's see, next up is the approval of minutes of the January 25th, 2021 meeting. Are there any corrections or questions or clarifications for those minutes?
Move we adopt the minutes.
Okay,
They look good to me.
all right. Do we have a motion to approve the minutes?
So move.
Second,
Second.
all right. All in favor?
Aye.
Aye, aye, aye.
Any opposed? So moved. Okay, next up on the agenda is the investment report for the third quarter fiscal year. And Courtney, if you could bring that up on the screen, I'll have Jason start off with that. And take it away, Jason.
All right, let me see if I think I can probably, if she enables me, I could probably bring it up on my screen if you guys would like to do that.
Also, Mark, it looks like Art is getting on here.
Okay. Hi, Art. You're muted.
All right, can everybody see that?
Yes, I see the agenda.
Perfect. And so I'm going to move down here to start off our report. And so just going to take a few moments. I'm sure that most of you have kind of read the pages on the economy and things like that, but just going to kind of hit some of the high points here on the overall economy, and then talk a little bit about the stimulus package. This is the $1.9 trillion. And also we have a little table that shows all the different stimulus packages because it becomes a little bit confusing given that we've had so many of them at this time. As Mark was taking a little poll around the meeting itself, lots of people being vaccinated for the COVID-19 virus, also reopenings continuing to take place, not only here in the United States, but also globally. Our own governor talking about, September 15th being a pretty important date here in California, as far as getting closer and closer to being back to some kind of normalcy here. With that in mind, the Biden administration, in order to continue to help us through this time of weakness in the economy, signed in a $1.9 trillion stimulus package. So that brings the total to about $5.5 to $5.6 trillion that we've had approved, and some of that being placed into the economy over the last 12 months. The $1.99 trillion, it is going to come in two segments into the economy, especially for public agencies. And so we're going to see some of the first pieces of that come within the next month or so here. And then 6 months from that, or a little bit further than that, you'll see an additional piece that's going to be played. The other thing that's being talked about as far as fiscal stimulus is a $2.3 trillion stimulus package related to infrastructure and infrastructure spending. Just being talked about. There is not anything out there yet today as far as it being passed. And also it seems like this is going to be something where there is going to be some sort of negotiation that takes place between the two parties, given that we have basically almost evenly split in the Senate. And so we'll continue to see how that mounts, but definitely all of this has contributed to the economy that we continue to see grow. I'll talk a little bit about that a little bit later in the presentation, but definitely we continue to see that growth is going to continue as related to GDP. With that, when we take a look at the Federal Reserve, as far as the Federal Open Market Committee and where they plan on keeping rates, and so the intent from what we're hearing from them is that rates are going to be between the zero bound, the 0.25 bound that we've had. They'll continue to purchase securities onto their balance sheet, about $80 billion worth of U.S. Treasuries, and then about $40 billion of mortgage securities in order to keep interest rates low, keeping credit flowing throughout the economy. And the policymakers, when you look at their dot plot, don't think that anything's going to change as far as when you look at the federal funds rate, which is the rate that they control in the very short end, not until 2023. Also, what we've seen is the yield curve in general, is we've seen some steepening of the yield curve. This has really started, I would say, back in November, and it's continued its way through all the way through March. We did see a little bit of a flattening that occurred here more in this April timeframe, as rates have actually come down a little bit on the longer end, but still the yield curve has steepened pretty dramatically from where we've seen before, and I'll show you that a little bit in the presentation also. As we move forward, this is the $5.5 trillion stimulus program that we've had in the last 12 months. So remember that we started out with the CARES Act, $2.23 trillion. Then we had the coronavirus relief bill, which was $484 billion. Then we had the phase 4 stimulus. So that was $908 billion. Then we have the American Rescue Plan, which is $1.9 trillion. And so far, we have about $5.5 trillion that has been approved, and much of it being spent already in the economy, but still having some more money that will be has approved and will make its way into the economy in the coming months. I'm going to focus on the 2021 American Rescue Plan just because it has some provisions here for local agencies, which the $908 billion plan had zero money essentially for local agencies. So individuals will get about $800 billion of this, or about 42%. Local governments, $360 billion will go out to local governments. So I'm sure that San Clemente is getting a piece of that overall pie. And so remember, that will come in 2 payments to the city. And then looking at transportation, housing gets about $280 billion, healthcare $228, businesses get $75 billion, and then the other categories about $146 billion, and that goes to cybersecurity and some other types of things. So that's where this $1.9 trillion is going to be spent in the economy over the next few months here. And so we'll probably see some effects on the economy as far as maybe some continued activity, actually maybe even some heightened activity, depending upon what happens.
Jason, question on that last slide.
Yes.
The 146 billion for pension bailouts and cybersecurity. I was under the impression that unfunded pensions were specifically excluded from these funds, and this is pension bailouts. Is that does that include unfunded liabilities?
It doesn't include unfunded
For local
liabilities.
governments. Local governments is another category.
It doesn't include unfunded liabilities, but it's really for the pension guarantee program. And so if you know, the government has a guarantee of pensions. It's an agency.
Those for federal employees, not for local.
It could be federal employees, also some private. So if you think about when a pension fund kind of goes bust or is not able to achieve its funded liabilities, think of the airlines maybe 20 years ago.
I guess what I'm asking, Jason, is we have the local governments, the 260 for local governments. I'm told that doesn't include pension, but I'm also told that the specific rules haven't come out. But I guess that what's intriguing is that 146 with pension bailouts. That's for feds. That's not, in your opinion, or do you know if that involves?
I don't know specifically because they have not given out the specific guidelines for that. But it does not include unfunded liabilities for local agencies, from what I understand, at least at this point. The rules still need to be written on some of this, so some of the details definitely still need to be kind of spelled out there. But as far as I know at this point, is that it does not include kind of state and local governments bailing out some of those unfunded pension liabilities.
Thank you, Jason.
All right. And then moving on to the employment situation. So here you can look at on the left-hand side is non-farm payrolls. And so this really tells the story of COVID, but really what I want you to take away from here is we are creating jobs. We're creating jobs on a monthly basis. And I think it's probably better to look on the right-hand side at this point in time is really look at the unemployment rate. And so the green line is what we call the U3, which is the unemployment rate. That's the typical rate that people quote and most economists will quote. And then of course you have the dashed line there is what we call the underemployment rate. Those are those folks for economic reasons who are not necessarily working to the fullest extent right now. And so what that might include is those people that are working part-time that might want to be working full-time. So you can see that number is higher. What I really want you to take away from here is two things. One is that it's recovered substantially from the lows that we saw not less than 12 months ago. And the second piece of that is that even though that we're making our way through this pandemic, we are still at higher rates of unemployment than we were pre-pandemic. And so when the Fed talks about when it potentially could move monetary policy in any way, shape, or form, many times what we think that they're talking about is potentially that they would want to see the numbers at least trending towards those pre-pandemic levels. And so we'll see if that really comes to fruition. But we think that the Fed is on hold, at least from the perspective of the federal funds rate and also from purchasing securities for a while here until we actually see the unemployment rate come down, as long as inflation continues to be what the Fed deems to be within its targets at that time. Then looking at forward, so here you can see initial jobless claims. So the green line on the bottom, the bars on the bottom are the initial jobless claims. The gray line there is what we call continuing unemployment claims. And what you can see there is that those continue to trend downward also. I do think as we continue to see more vaccinations, easings of some of the restrictions, it will continue. We can think about some of the industries that are still affected. Think about airlines, things like that, where as you continue to see people vaccinated, as the rules change, you'll see employment start to pick up in some of these different areas. Then looking at page 7, this is looking at the consumer price index. And so you can see the green line there is the year-over-year number. Remember that CPI is the broadest measure. And then you can see that the dashed line there is what we call the core CPI, and that excludes food and energy. You can see that basically the headline number continues to go up. The core number is actually kind of slumbering down there, actually declining a little bit. The expectations that we will continue to see the CPI pick up here. If you think about it, we're kind of going to reach that low level in March. And then we will likely see the CPI on a year-over-year basis maybe trend up to even north of 2% at this period of time. So with that in mind, we definitely do see inflation is picking up, but remember, from very, very low levels. If you look on the right-hand side, what you can see there is the personal consumption expenditures, or the PCE. I would think of this as probably the Fed's more preferred number, looking at inflation, i.e. a broad level of prices. The green line there, again, is the headline. The dashed line there is the core number, and you can also see that that's trending up there. But definitely remember that the Fed has talked about a 2% goal or target for the PCE, and we haven't seen that in 2 years. Also, the Fed has changed its tune a little bit and said that it'd like to see an average of that 2% over time. And so they're a little bit looser with some of their language as it relates to monetary policy and where they'd like to see inflation over that period of time. So I do think that one of the things that we can take away from what the Fed has said more recently is that they would likely let inflation run hotter than that of previous Federal Reserve governance because of some of the things that they talked about, and also not being able to achieve the goals in a long period of time. So inflation has definitely not been one of the things that's been their enemy at this point. When you look at page 8, here you can see gross domestic product. This looks at the last 4 quarters, and it really tells you the story of the pandemic. So on the left-hand side here is a chart. Here's the different types of, grouping things into different ways, and then also a total. So you can see the first quarter, we were down 5% if you go to the bottom. Then you see the second quarter, we were down 31%. Then we got a big rebound back in the third quarter, up 30.4%. And then in the fourth quarter, up 4.3%. We're looking at expectations for 2021 north of 6%. That would be a very robust growth for any annual year going back to like the 70s or the 80s. is you have to look at some of those recoveries that we saw back then. And so definitely, I think that you're looking at a very robust picture as far as GDP growth. Remember, a lot of that is influenced from stimulus programs and also looking at where overall interest rates are. The graph on the right-hand side, the green bars there are the quarter-over-quarter changes. The maroon line there is the year-over-year change. For all of 2020, we were down around 3.5%. Remember, that's much better than what a lot of experts were saying. There's even the Federal Reserve will say is that the economy is doing better than what their expectation was. And so I think that 2020, although a dismal year in general, I think that the expectations were a lot worse, and we're starting to see some pickup because of some of the actions by not only the monetary policy, but also the fiscal response, not only here in the US, but also globally. Then moving forward, any questions on the economy or anything that we went over there?
Jason, I have a quick question regarding your comments on inflation. You mentioned that the Fed is comfortable with an inflation rate higher. How high are you talking about? Do you have any idea what kind of inflation rate the economy can expect?
Yeah. So if you think about the Fed is always very ambiguous. It's been ambiguous probably since the Greenspan era.
That's why I was asking for a little bit of specificity if you have any.
So what I would say is that what I would think is that if there's an expectation of higher inflation, it doesn't have to be something that's back in the 1970s. If you look at it, inflation has been running below 2% for a long period of time. All we would have to have is inflation start to run at 2.5%, maybe even 3%, which would be back to some of its more historical long ranges. I would think that we are going to start to see inflation at least start to trend upward from here, and we'll see if that takes hold, because I think not only does it need to trend upward, but it also needs to take hold. One of the things in the economy today that people are thinking that, or participants are thinking that might propel that inflation is, one thing is that we've had all this stimulus that has gone into the economy. Right now, our savings rates are really high, meaning that Americans are saving a lot of that stimulus because there isn't that much to do. You can only buy so many things. So the velocity of money right now is pretty low. How fast money is churning in the economy. The expectation is that will pick up. And with that, you're going to start to get higher levels of inflation. If you think about the government and things like that, and you think about the debt load, I think that the Federal Reserve would actually invite higher levels of inflation, closer to their 2% target. I think that they've been looking for that missing piece for a long period of time. And now the trick is that you don't want it to go too high. My expectation is that you wouldn't see any kind of 1970s inflation. First of all, you'd have to see pretty dramatic increases in wages. And one of the things that you would also see is you'd have to see lower productivity in general. And we haven't seen that. We've actually seen some higher productivity numbers. All right, moving forward, looking at the characteristics. This is of the consolidated portfolio. So this includes all funds. So if you think about it, some funds are managed by Chandler, some funds are managed internally, and then there's also a very liquid pool that is really looking at kind of day-to-day expenditures and ensuring that those are available. If we look at March 31st, I'm really just going to look at the portfolio, and what you can see is on the portfolio is the average maturity is 1.37. The average duration is 1.29. Remember that the duration is your sensitivity to interest rates. And so really it's about 1.3 years at this point. So a really kind of short-term portfolio. So if you were to see inflation, if you were to see interest rates increase, definitely the city's portfolio would adjust to that, i.e. into a higher interest rate environment, because it would be able to reinvest maturities and things like that pretty quickly. Also, the market yield is 0.32. You can see it's a AA plus rate portfolio, and the portfolio's approximately $147.8 million is in the portfolio today. Here you can see, looking at the historical purchase yield to maturity, and you can see that that has been coming down, and there's some reasons for that. Right now in March 2021, it's 1.24%. One is as the securities mature off, we're reinvesting to a lower interest rate environment. Also, when you look at some of the investment pools and things like that, that the city has money in, they're also having to reinvest into a lower interest rate environment. Today, if you look at LAIF, which is actually a really competitive yield for overnight money or very short-term money, it's averaging about 33 basis points. There was a time that it was closer to 2%, things like that. So it is coming down. So the city's portfolio is coming down along with that as far as the overall yields of the portfolio. But by purchasing longer term securities, we've locked in some of those yields. And so that's been beneficial to the portfolio. Here you can see looking at earnings. So you can see, basically fiscal Q3, and you can see the green line is that of 2021. The gray line that is that of March 2020. So you can see a pretty significant drop there. You can see right now 480,000 for the most recent 3 months. Before that was about 730,000. And so you can see that's from that drop in that overall yield. And then you can see the fiscal year to date. You can see most recently 1.6 million versus 2.1, almost 2.2 million if you look at year to date fiscal last year. And again, that's because yields are dropping on securities, so there's less earnings at the same time. Here you can see page 13 gives you a broader look at some of the portfolio characteristics. And what you can see is the broad sectors. So you can see U.S. Treasuries, agencies, corporates, ABS, which is asset-backed securities, negotiable CDs, commercial papers, supranationals, also looking at LAIF. You can look at the money market fund and cash. What you can really see here is that LAIF increased that balance. So that balance as of December was about 42.1. Now that's about $46 million. So about almost a $4 million increase there. Where we've had some decreases is really that in agencies and some corporate notes, where we've had some increases in U.S. Treasuries. Right now, the yields on U.S. Treasuries are almost right on top of U.S. agencies. And given that dynamic, we have been purchasing some more Treasuries in lieu of agencies at this period of time. We'll see if that dynamic changes over time, but definitely you're looking at a very what we call tight spread environment, the amount of interest that you earn over a U.S. Treasury across all asset classes.
Jason, quick question. I see a decline of about, or decrease of roughly $2 million in corporates. So how do you see corporates in terms of what they're yielding compared to treasurers and agencies and their attractiveness as far as the spreads?
So let me give you an anecdote, and this is one of the most interesting anecdotes out there. Last week, Procter & Gamble, a AA rated company, a company that would be under consideration for purchase for the city, issued a 5-year note out there. It paid 20 basis points over the comparable U.S. Treasury, which is a rate that we hadn't seen since the 1990s. That's how low spreads are today in that environment. So how do we look at corporate securities? We want to be very careful when choosing corporate securities today. One, they're not offering very much reward today, and we think that there could be some greener pastures in the future. But it may take us a little while to get through that. There is really a lot of money today chasing few opportunities in fixed income markets. And a lot of that has to do with all the different things that have gone on through the pandemic related to financial markets and things like that. And so it continues to be a tight spread environment, and we were really choosing our points when we purchase corporate securities. The great thing is that we already had a decent size allocation before. And so, we continue to hold that, but definitely it is a tough environment to find securities which we think are priced appropriately.
Great, thank you.
Here you can see in a pie graph, looking at the same thing that we were looking at before. This is just percentages. And so you can see about 37% are in U.S. agencies. Asset-backed securities about 1.7%, U.S. Treasuries about 18.6%, supranationals about 1.4%, negotiable CDs about 1.4%. Here you have a small amount of money market fund, less than 1%. LAIF makes up about 31% of the total portfolio, and then you have corporates making up about 6.7%, and then cash, meaning like bank deposits, things like that, making up about 1% of the portfolio. Here you can see looking at the industries represented. And so this includes all the industries. We're going to count the government as industries and also pooled investments as industries. But you can see just looking across there, government securities make up the majority of the portfolio. Then you have pooled investment vehicles. That would be LAIF. Would be the other pieces of that. And then you can see the different industries that are made up. And you can see that we have a diversified portfolio, but you can see that there are some higher levels. You know, banking typically makes up a big percentage. Technology used to make up a bigger percentage, but then they changed the tax laws where technology companies no longer issue debt to do dividends. Basically, they do it off of their own balance sheets and repatriate funds. And so that has been a market that has kind of closed down a little bit there as far as an industry that has some value.
Hey, Jason,
Yes.
I have a question. With spreads as tight as they are in corporates and agencies, are you guys considering selling corporates and agencies and buying treasuries, or do you think spreads could tighten even further? I mean, what is your take on that, and what are your thoughts in terms of how you would strategically deal with that?
So let's talk about treasuries and agencies. In some instances, we have been sellers of agencies, especially when we see that basically spreads are through treasuries, where you actually get a pickup in yield when you sell the agency and buy the treasury. And so definitely we've been net sellers in those environments. On the corporate side of the equation, we haven't necessarily been net sellers. We also haven't been accumulating a lot of corporates. Where we have been purchasing corporates is actually in the new issue market more than anything else. That's where we think that at least you can get a concession there and garner some of that increased spread. The problem that you end up with corporates is I think also bid-ask spreads are pretty wide too at this standpoint. And also just the scarcity of a corporate to purchase back into your portfolio. That's the other thing. You go to sell something and then what do? Do you go into a treasury? You give yield. You may be able to, pick something back up as spreads widen out. We do think that we could be in this environment for a little while here. We're just kind of playing it by ear, for lack of a better term, to see where we're at, but definitely becoming more and more choosy about corporates and where we enter the market at this point.
Okay.
Then looking at page 16, so if you remove the different pools and things like that and the government securities, here you can see where we have different holdings in the different industries. Really, if you look at the top ones that are here, it's really banking, financial services, and also technology makes up bigger percentages of that. And so you can see that in this graph here. Here you look at the quality distribution, and so you can see your portfolios in the green. The gray is that of as of December. The green is that of March. I'm sorry about that. If you look at it, not rated securities, those securities are either rated by Moody's and or Fitch, or in this instance, the more majority that not rated is actually LAIF, but we're very comfortable with the way that LAIF is run. So we're not really concerned that they don't have a rating on LAIF. But on an S&P scale, all the other securities are rated A or better. And so you can see that in this graph here. Here you can see on page 18, this is looking at the duration distribution. Think of this as a maturity distribution. Remember that your portfolio has a 5-year maximum maturity. And so you can notice, first of all, that the 5+ bucket has 0 securities in it. And then what you can see is really there's a lot of funding up on the very front end. Remember, this is probably the time of year that the city has the most liquidity, meaning that it's getting the most revenue sources at this period of time. And so it will continue to kind of ebb and flow, but this is really the high point, or one of the higher points that you'll see the liquidity position. After this, especially as we move into those months such as September through November, you'll see that the liquidity balances will be brought down by just the expenses and the operations of the city. And so right now it looks like liquidity balances are very high, but remember that a lot of those funds are going to be spent probably within the next, I would say, 6 to 9 months as we continue to make through ourselves through the cash flows and things like that of the city. Then you have here, this is looking at the consolidated portfolio, and this does not include LAIF, nor does it include any of the cash elements, which tend to distort that a little bit. And so what you can see here is your portfolio as of March is in the green. In the gray, you can see that is as of December. You can see that most of your securities are between like 2 and 3 years. Definitely, we have purchased some securities out in the 4 to 5 and also the 3 to 4 year. A lot of those securities we purchased more than a year ago. And so definitely those securities are some of those bigger gainers and being able to lock in some of those higher yields. But also look that we also have securities that are maturing off relatively soon too. And so if we were to have a higher interest rate environment, definitely been able to reinvest back into that. Here you can look at the total returns of the portfolio. So this is looking at a lot of different portfolios. And so what we have here is, if you look at the graph above, and so basically you're looking at the dark green is the 3-month, the gray is the 12-month, and the lighter green is the since inception. So you can see the Chandler managed portfolio that's on your far left-hand side. You can see the internally managed portfolio right after that. You can see the consolidated portfolio, and then you can see 3 benchmarks. Bank of America 1 to 3 year Treasury Agency, 1 to 3 year triple A rated or better corporate government. And then you can also see the 0 to 5 year US Treasury benchmark. And if you look down at the table below, what you can see is over the last 3 months, rates have gotten higher, have moved higher from where they are. So you're on a total return basis. Remember that total return includes not only the income, but also the fair market value change in those securities that you own. So slightly negative, what you can see, except for in the internal managed portfolio, which was actually up 9 basis points. But as you move out to 12 months, you can see that the Chandler managed portfolio was 0.90. You can see the internally managed portfolio was 73 basis points, and the consolidated was 1.81. And then if you look at the since inception, the Chandler portfolio, 1.68 versus 1.14 of the internally managed. Remember, the internally managed portfolio is a shorter term portfolio. So typically its returns are going to be less than that of a longer term portfolio over longer periods of time. And then finally, you can see the consolidated portfolio at 1.41%. And then you can see the benchmarks that are right below that. So I would say the best benchmark or portfolio to benchmark against is really the Chandler managed portfolio, because its duration and things like that is closer to that of the benchmarks that we have below there. And so you can see on a since inception basis that the Chandler managed portfolio has outstripped that of the benchmarks over those period of time. And then you can also see that when you're looking at the Chandler portfolio on the 1 to 3 year basis on the government. And then when you have the corporate and government lagging a little bit, around 5 basis points, and then the 0 to 5 year Treasury definitely outstripping that by a material amount of return there. Here you can see net of fees. So you can see the same thing. So you can see that now. You can see over the 3-month, 12-month, and also the since inception. Remember, the duration that we're following now is closer to that of the 0 to 5 year benchmark. So if I would look at the Chandler managed portfolio versus the benchmark, I would use the 0 to 5 year. But as we've talked about before, we wanted to use a couple of different goalposts to understand kind of where the portfolio fit between some of these other different types of benchmarks also. And then you can see, just looking at a yield comparison, this is purchase yield. So you can see that you can earn a whopping 2 basis points. This is almost deja vu, because I think when I first started presenting to this committee, this is where 3-month T-bills were way back when. And so it's amazing how things come back around again. 6 months, you can earn a whopping 3 basis points. Life is now at 35 basis points. This as of March 31st, it's actually come down to about 32, 33 basis points since that period of time. Commercial paper is 17 basis points. A government money market fund is 2 basis points. And your portfolio's purchase yield is 1.24%. And that's because you own those longer term securities, is why it's so much higher than that of some of those comparables. Here you can see the yield curve. This is looking from December 31st to March 31st. The gray line there is as of December. The green line there is as of March. And the steepening of the yield curve, you can see that pronounced here. And so what you can see is that short-term rates, everything 2 years and in, relatively similar. As you go 2 years and out, what's happened? You've seen that rates have started to increase. Thus, we have a steepening yield curve. So there are definitely more opportunities that are out there towards the longer end of the spectrum. Remember, this was as of March 31st. Actually, yields have come down pretty considerably, 5 to 10 basis points, depending upon some of the different maturities. But the most of the activity is taking place 5 years and out. That's where we're really seeing the majority of interest rate increases. Also, you're now being compensated for going out the yield curve. And so remember before, when we were buying some of those longer term investments, it was hard because it was a very flat yield curve. Then yields just dropped. And so definitely that was a very good environment for this portfolio and some of those longer term securities. Now, what's the benefit of purchasing longer term securities? Well, now you can roll down the yield curve. And so you can buy something that's out, 5 years at 94 basis points. And by the time you get to 3 years in there, you're at 35 basis points. And so that's a pretty steep yield curve at this point. Can it get steeper? Absolutely, it can get steeper. 08, 09, we're probably around 50 to 100 basis points steeper than we are today between 2s and 10s. And so definitely we could see that. And that would be kind of that scenario where purchasing those long securities wouldn't necessarily do as well, at least in the short term. But definitely it could take us a while to get back out there.
Jason, a quick question. What's Chandler's viewpoint? I mean, we talked about inflation increasing in all probability with all the stimulus that's being injected into the marketplace. So what's Chandler's viewpoint in terms of where our rates are going to go, say, over the next 12 months? So
I'm going to talk in a couple of different places here. So I do think that there's an upward bias to rates, just in general. And I'm going to come to it from a couple of different angles. I know what's being talked about today is inflation. That's kind of the headline number. But I invite everybody to think about this. The US Treasury this week will actually issue around $140 billion worth of treasuries this week. These are monster supply. Those of you that have been in the markets for a while, we've never seen this amount of supply as a percentage of anything. And so you have a lot of supply in the market. You have a big demander now, meaning the Federal Reserve purchasing, approximately, let's just call it $1 trillion, maybe, of treasuries per year. So that also has a bias towards those rates. And then on the inflation aspect, definitely I think that you're going to see inflation potentially moving up a little bit from here. We already have seen a huge move from where we are today. So we've already seen a pretty big move. I do think that, to see another, 15, 20 basis points, depending upon where you're on the curve, would not be unheard of. But I do think where it will take place more is not necessarily kind of in that, 2 to 3 year range of the yield curve. I think you really have a tale of two curves. The short end of the curve is going to be landlocked by the Federal Reserve, basically keeping rates at zero, and the longer end of the curve, where inflation and some of these other aspects take place, you're probably going to continue to see an upward bias and that steepening of the yield curve at the same time.
Okay, thank you.
Jason,
Yes.
it's Art. Going back to page 20 and 21, could you share your perspective here on, the negative total return and how long we might expect the negative situation to continue, and maybe some of your thoughts on things that we should consider to do?
Sure. So let's just focus on page 20, because I think that gives you kind of the broadest set of measures there. So let's think about the 3-month number. And so the 3-month number was definitely affected by the steepening yield curve. And so if we took a picture today of, kind of where rates are today, and let's say they don't move very much, you're actually going to start to see some positive total returns, because actually rates have come down. And so from that perspective, I think that, rates definitely, some of those total returns that we saw in the first quarter of 2020, if you look at, how far rates moved and how fast they did, it is really one of those, outlier events, I would think, is when you look at, kind of the speed at which that happened. I think more gradually, as you move forward through the pandemic, you'll probably see a much more gradual change in rates, but I definitely think there's an upward bias. What I think the committee should think about at this period of time is a couple of different items. One is that credit spreads remain low, so there's not necessarily a tremendous opportunity in corporate bonds to protect you from that. So one of the things that we want to protect you from is not necessarily where overall interest rates go, but also protect you from credit spreads at the same time, because credit spreads remain relatively tight. The other aspect of it is that to look at the portfolio and how steep the yield curve is today, is that to take advantage of some of those opportunities further out the yield curve and be able to ride down that yield curve at the same time. With that steep of a yield curve, traditionally, that has been positive to those that are willing to go out there and take that. Even if rates were to rise for a couple of months, you roll so fast down that yield curve, there actually may be a mitigated price effect as you look at that. So the two things I think the committee should think about is really how steep is the yield curve? Our benchmark and our targets allow us to take advantage of that. If you think of our benchmark, it's between 0 and 5 years. And then the other aspect is to protect the portfolio related to credit spreads, because credit spreads are so tight today, not necessarily, keeping the holdings that we have, but not necessarily going overboard on new purchases of corporates and other types of instruments like that.
Yeah. Well, I mean, I was even looking at 5-year Treasury on Friday, and I know that's like, last week, but that was only paying 83 basis points. It
Yes.
just doesn't seem like there's a lot of long-term opportunity. And so sitting in life at 35 is maybe not unwise until we see things start to.
But remember with LAIF, the one thing you got to think about LAIF is going to come down with the rest of them.
Right.
So,
they're going to come down with us. Yeah.
So, and the other thing to think about LAIF is, so a lot of times we just quote yield when we think about LAIF. The other thing is LAIF is a portfolio of securities. LAIF is now at around 250 or 260 days average maturity, not less than a year ago, about 180 days. And so their ability to reprice, even if you were to have kind of a rising interest rate environment, is less these days, because they have gone much further out the yield curve than I've seen in a long period of time. And so I think that's, you got to put, when you think about LAIF, to put those two pieces of the puzzle together. They're extending out, and they're also, the only reason that they're keeping up that yield or preventing that yield from falling even faster is because they're pushing those securities further out the yield curve. And so you do have more duration risk in LAIF than you otherwise would have.
Thank you, Jason.
All right.
And Jason, just to follow up with that, and so what that may mean is if interest rates start running up, LAIF may lag and stay where it is, not run up as quickly as it might otherwise if the duration was shorter.
Correct.
Yeah.
Correct.
This is just the traditional time when you would want to extend. So you get the roll down because you're almost in a can't lose basis. And it might be hard for you guys to hear me saying now to extend to get longer, but this is traditionally when you just roll down, because if you get out a little, you need rates to go up so much in the short time before you're in a losing position on that bond.
Yeah, I'm writing the date down, Al, that you said this, extend maturities. Okay, got it. Just kidding.
Jason, I have a quick question for you on, I think it was on page 16, you were showing the various industries that we were invested in. There was zero investment in the insurance industry. And I think a couple of others. Why insurance tends to be profitable? Why do we have nothing in the insurance industry?
So traditionally what happens is insurance and things like that, when they're funding their balance sheets, traditionally tends to be longer securities. Also, some of those securities tend to be actually a lesser quality because it's at the holding company, not actually at kind of the policy levels. And so think about AIG. AIG is a big issuer, but they would have a BBB rating. And so from that perspective, and when we look at different types of insurance companies, they have different funding mechanisms a lot of times than just corporate bonds. They're funding through different policies, different investments, guaranteed investment contracts, and things like that. So traditionally what you'll see is there isn't necessarily a ton of issuance that comes out of insurance companies. And traditionally what we've seen is some of the credit spreads that you get on insurance is very low. And so really looking at not only the risk portion of that, but also the opportunities.
So it's just not a sound risk investment in your opinion?
Yeah, I always look at it relative risk and return. So very sound companies, but the return aspect of it relative to
Okay.
other corporate securities doesn't necessarily make as much sense. And then the other one, Steve, that you might have seen here is the basic industry. And a lot of times what you're seeing there again is a lot of times they're funding 10 years out because there's a longer term liabilities or funding property, plant, equipment, and things like that. Think of a cement company or something like that. And so a lot of times you're not getting some of those longer term bonds that are out there. All right, any other questions before we move forward? All right, here you can see compliance. So here's the great news. We fully comply with the investment policy and California government code. And so anytime if I say anything else than that, definitely ask me a question, because this is really, at the end of the day, the governing document is the investment policy that comes before the council on an ongoing basis for approval. And really that's our governing document. So we want to always stay within the parameters of our governing document. So you can see that we are within the parameters of all of the different constraints that are part of the investment policy. And then here you can see some of the consolidated holdings. And so you can see here just different of the different companies consolidated up. You can see that Lath and also the different government entities such as U.S. Treasuries and its agencies make up the bulk of it. And then when you go down there, basically you see under different corporations and things like that, that they are typically less than 1% of the portfolio. So really a diversified portfolio amongst industries and also companies, basically not putting all of our eggs in one basket. And then you can see the different holdings. I'm going to go through this relatively quickly. Just the pages here, you can see any individual security that we own. I'm going to stop here just on the negotiable CDs. Noticed that the negotiable CDs are all $250,000. And so important, no matter what the institution is, as long as it's an FDIC insured institution, those are fully insured by the FDIC. And then you can see this is something that Mark looks at on an ongoing basis, the maturities by month. And so able to look at the different maturities coming available, looking to ensure that there's enough cash to facilitate the operations of the city. And then here you can see the transaction ledger. And Mark, would you like me to continue through page 46 and just talk about the Chandler portfolio? Or do you think that we've talked about those? Mark, you're on mute.
Sorry, I didn't unmute. Yeah, if you could go through that, you could go through it pretty quickly and just make sure there aren't any questions.
Sure. So remember that this is the Chandler managed portfolio. So this is the longer portfolio, has a higher average duration and maturity. And you can see that it's managed to the 1 to 3 year U.S. Treasury agency index. That's the index that's in the investment policy. And you can see that that portion of the portfolio, looking at the portfolio characteristics, is about $82 million. And you can see the average maturity of that is 2.23. The average duration is 2.11. You can see here that the average purchase yield is 1.64. The market yield is 0.33. It's a AA rated portfolio, and it's essentially almost $82 million. You can see just looking at the different asset classes, and you can see some of the changes that have been going on here. And so as you saw through some of the different transactions that we shown before on the consolidated, we have had some maturities in corporate notes, just have not seen any opportunities. So that's come down. We have put some more in U.S. Treasuries at this point. Also, we had some negotiable CD come off there, but definitely looking for some opportunities where we possibly can find those in this environment today. Here you can see the sector distribution. You can see that this portfolio is about 57%. This is just that piece of it. The asset-backed securities are 3.1%. Treasuries make up about 23.6%. Notice our treasuries are increasing. Our agencies are basically, they declined a little bit, but definitely have not been adding there. You can see that supernationals, you can see the money market fund is about 1.4%. We have been investing those funds since this period of time. Corporates went from about 14.6 to about 12.2%. And so when we do find corporate opportunities, definitely we're taking advantage of that. And typically where that's been is in the new issue market. We think that there's better opportunities there. Then on page 50, so you can see essentially looking at the different companies that are part of the portfolio. And then you can see what the duration distribution looks like there. You know, the green is March, the gray is December. Most of the portfolio is around 2 to 3 years. That's pretty traditional, but we have been starting to buy, you know, some 4 to 5 year. And if you look at that 3 to 4 year bucket, you know, having a little bit more in those areas. Here you see it fully complies on the next couple of pages. And then the next couple of pages are the internally managed portfolio. Any questions?
Okay, if there are no more questions for Jason, well, Jason, thank you very much for your presentation. Very good as usual. Appreciate that. I could take over the screen sharing if you want to.
Before we let Jason go, Mark, can I have a quick question?
Yep.
Jason, real quick, the infranational investment had a 2.5% of the portfolio. Where are those stocks listed? The next page, I can't tell which are the infranational.
Oh, the
stocks.
supranationals?
The supranational, excuse me.
Okay. Yes, I think they are. Let me see if the holdings are here. If not, I'm just going to go back really quickly to the holdings of the entire portfolio.
On page 50.
It's page 50.
Well, yeah, I mean, if you want to just the issuers.
Yeah,
There
I
you
didn't
go.
see them. I was just wondering what they were
So,
on 50. I didn't see them.
There's
so
CVs from foreign companies and foreign nations.
So what they are is they are quasi-government entities, and basically there's a consortium of nations, the
And
U.S. being
where are they on that page? I don't see them. Maybe they're there and I just don't recognize them.
Towards the middle. I don't know if you can see
Steve,
that.
I'd go to page 33.
So
Steve,
they're
go to 33.
okay.
And-
Intra-American Development Bank and International Bank Recon Development. Okay, I got you. I see. I didn't see those before. Okay. Okay, that answers my question. Thank you very much.
Okay. And let me move this back where we were, Mark. And let me see if I can. Not as good as I should be at some of this. Mark, can you ask for control?
Here, this will stop screen sharing. Do you want to continue? I'll say yes. And now I got to find the right one. There we go.
And I'll stop mine.
Okay, can you guys see that?
Oh yeah, that's bigger.
All right, good. So let's see. We left off on page 54. Jason, again, thank you so much for your presentation, and appreciate everything. Okay, so the internally managed, what you'll see here on page 55 is the average maturities and the modified duration have gone down quite a bit. And that's reflecting that almost all maturities have been funneled into LAIF up until this point. Just getting ready to actually start buying some treasuries. I've been talking to one of our brokers about that. So it's, yeah, to me, I think it echoes what Al was saying, that there isn't a lot of risk now to extend out on the yield curve. I think the last time we met, LAIF was close to 50 basis points. And so it's come down a fair amount, or maybe it was in the 40s, but in any case, as of 3/31, we had quite a bit in LAIF, and it's actually given me pause to think about, okay, what is our limit with LAIF? And it's $60 million, so we're still a ways away from it, but in any case, we've never been close to, at least not in the time I've been treasurer. And you can see what the average purchase yield has gone down correspondingly, as far as also the average market yield, and the average quality has remained the same. And the portfolios as of March 31st was about 66 million. And that's almost the same as what it was at the end of the year. So here you could see, I think this slide on page 56 is you could see what's been maturing, the treasuries, agencies, and you can see that has been funneled almost entirely directly right into LAIF. So, and then on page 57, it's just simply the pie chart reflecting what the previous slide went over. And here again, you see the preponderance of securities in LAIF for cash and LAIF. The next slide shows what it is excluding LAIF and cash. And we've just, probably a year ago, we had some 4 to 5 year securities. And we're certainly a year and a half ago, and those have just kind of run off as they've matured, and most of the monies, certainly in the last, I'd say 6 to 9 months, have gone from maturities into LAIF. And there you see the issuers for the internally managed portfolio. Any questions on that? Okay. Page 62, I should say, is a certification. And then page 65, we have the pension portfolio, which again, the investment advisory committee really doesn't have any control or comment on. We put it in the report for public. I think the interesting thing here also is just to see what the pension allocation, asset allocation is. It's obviously much more equity driven for longer term returns. And there's the investment allocation on page 66, where the different funds are between the general funds and the different street improvements, et cetera. Any questions? Actually, on page 68, this is always a good, I think, chart just to see where the inflows come in. And as Jason pointed out, we've just kind of finishing up getting the inflows, so we're pretty flush with cash. And then if you run off to June and then go back to the beginning in July, even though it's July 20, it's a very similar inflow outflow picture. Probably the only other comment I would make on this is under disbursements, the paragraph at the bottom, there's quite a big difference between projected disbursements of 12.9 million and actual disbursements of 9.8. and I asked for some clarification on that from Jake, and he gave me some comments such as sheriff's contract was a lot higher the year before, and so that went into how they projected it. And also, and correct me if I'm wrong on any of this, Sandy or Eric, city expenses have been lowered quite a bit. And so that was part of it. And some of it's just the timing of the payments.
It's accurate. Thank you, Mark.
Okay. Other than that, just the cash flow on the rest of the pages. Any questions?
Mark, were you looking like for a vote and permission to buy some treasuries?
No, I wasn't. It was more of kind of letting you guys know the thought process of why Leif had built up so much. And the fact that, I was just in the process of looking at treasuries because of the run up in yield prices there. But as long as I stay, I mean, the internally managed part, Al, has always been very short, very high quality. Never go into corporates. Just really stick to basically treasuries, agencies, CDs under the FDIC shared limit, and Leif, and that's pretty much it. Pretty plain vanilla. Yeah. All right, if there aren't any other questions, I'll stop the screen sharing. And let's see, we need a motion to approve the third quarter investment report as presented.
So moved.
Second.
I'll second that.
Okay, all in favor?
Aye.
Aye.
Any opposed? Okay, so moved. Thank you. Okay, do we have any public input, Courtney?
No, we do not.
Shocking. Okay, every once in a while we get lucky though. Okay, that's really it. Actually, I know the committee spots of those for Al and Art are coming up. They've been well, actually they came up, I think at least one, if not both of them, have been up for some time, but I believe the city council is going to be taking applications pretty soon, and then appointing the citizen representatives. Is that correct, Eric?
Sir.
Okay. Do you know when the applications are going to start going out?
I think for investment advisory, they'll be coming out probably in the early to middle part of May. And then obviously conducting those interviews prior to the seats expiring. I believe they expired June 30th. That's what they were extended to.
Okay.
So those new players would need to be in effect, in essence, July 1.
Okay. So Alan, Art, if you want to continue on, make sure you get your application in, and then the one of the changes made was that the investment specialist is appointed by the city treasurer. So I'll be handling that. All right, if there aren't any other questions or comments, we're ready to adjourn the meeting and that'll be, so what I need is a motion to adjourn the meeting to July 26, 2021 at 5:30.
I'll move we adjourn the meeting to July 26th at 5:30.
Very good. Do I have a second?
I'll second that. We'll meet in person too. Okay.
Okay, we'll cross our fingers, Al. I'm with you. Be good to break bread together. Okay, all in favor?
Aye.
Aye.
Any opposed? So moved. Okay,
So,
folks.
Mark,
Yes.
I was just going to mention that there is a definition for supranationals in our investment policy. And that
Yes.
there's also some good stuff, online. It
Good.
discusses, the issuing parent agencies and how they're structured.
Wow.
Thank you.
Now, they're an interesting security, Steve, and they're one that I think the committee thought about for probably a good 2 to 3 years before we decided to add them to the investment policy.